Everyone, thanks for joining. We'll give it maybe 1 or 2 more minutes for some people to join, and then we'll kick on with the webinar. Okay, so while we're waiting, just some quick housekeeping things. You might see on the screen, everyone, that there's a questions button. So if throughout any time during the presentation you can think of a question to ask, please send that question through. I'll at the end of the presentation, I'll come back and go through those questions and try to answer them for everybody. But I think we'll kick off now. So thank you everyone for joining. So the purpose of this webinar is going to be looking at employee share and option schemes, or ESOPs, specifically as they relate to startup companies, just to go through the various tax concessions that are available for those types of schemes, and some of the details around how to set up a plan, if that's of interest to you. Okay. So quickly about myself. My name is Glenn Reinhardt. I'm a tax and advisory director here at Incorp Advisory. So I've been in the accounting industry for about 20 years now, working at Incorp for just under 8 years. Just a little bit about us here at Incorp Advisory. So we're an award-winning full-service advisory firm. We're here to provide the support our clients need to grow their businesses and to guide them through each stage of your growth journey. We are headquartered both in Sydney and Perth here in Australia, and are part of a regional network with offices in 9 countries across Southeast Asia. So those offices are in Singapore, Australia, Hong Kong, India, Indonesia, Malaysia, Philippines, Vietnam, and more recently, China. Okay, so ESOPs for startups. So employee share and option scheme, or ESOP, it's a scheme that's designed to align the employee's interests with your company's growth. Now, this is an incentive scheme that employees might offer. So employers might offer their employees over and above their ordinary employment contracts. So it's not designed to replace, it's more designed as a supplementary incentive scheme. You may often hear ESOPs referred to as an employee share scheme, or ESS. There might be some nuanced differences, but for all intents and purposes, if I'm using one term or another interchangeably, they're the same thing. Specifically, this seminar is going to be looking at the Start-Up Concessions, which is a particular tax concession offered by the ATO, which started back in July 2015. So reasonably new. Before we get too far into it, might go through some common terms that we're going to be dealing with throughout this the webinar. So it's important that we understand exactly what we're talking about. So options being a right to acquire a share in a company in the future for a predetermined price. So if you get issued an option, realizing that you're not a shareholder yet, something will need to happen in order for you to then become a shareholder. So in terms of ESOPs, the issue or the grant date is an important date, which is the date that the option itself is issued to the employees. Exercising an option is the act of converting that option into a share. So it's only once you exercise your option that you then become a shareholder in the company. If the company has a shareholders agreement, which is a separate governing document that often solicitors can help a company put in place, at that point in time, the employee who is now a shareholder should become party to that separate agreement. Exercise price is an important concept. That is the price that an employee must pay in order to exercise that option. And that price and that amount is paid by the employee to the company. Vesting date is the earliest date on which a particular option can be exercised. And the vesting conditions are the criteria that needs to be met in order for those options to vest. Common vesting conditions could be a time-based vesting, whereby the employee receives a bunch of options, and those options vest, a quarter of those options vest every year for 3 years, for example. So it's a time-based vesting criteria. Or alternatively, it might be a particular milestone that the company meets. For example, if the company hits a particular revenue milestone, then the options will vest in that scenario. Or alternatively, the options will vest when in the event of an exit event, so when the company is sold. Those vesting conditions can be tailored to the particular employee that you're offering the options to, and they need not be consistent across all participants of the plan. So I'll just touch briefly on the different types of ESOPs. When I say types of ESOPs, I'm talking from a tax outcome or a tax perspective, realizing that the focus of this the webinar is on the startup concessions, but I'll just briefly deal with the other types that you may encounter. So the first one is taxed up front, whereby the employee receives the options, and those options presumably have a value to them. And the employee will pay tax in the year that the options are granted based on the value of those options. In practice, that's a pretty undesirable outcome for the employee, purely because the employee's got a tax bill, but they haven't received any cash for which to fund that tax bill. So where possible, when structuring plans, we try to avoid that particular scheme. The other one is a tax-deferred scheme, whereby employees, they don't pay tax up front. There's a future taxing point. Typically, in my experience, that tends to be when the options vest. So once the options vest, which might be some stage down in the future, that's when the taxing point arises. Again, not necessarily the most ideal outcome, because there's a tax bill and they haven't necessarily sold the shares. But again, it's a different option that's out there. The one that we're dealing with primarily here, the startup concessions, when you compare it to the other two types of plans, it's pretty attractive from a tax perspective. There's no tax when the options are issued. There's no tax when the options are vested or exercised. The only time that a taxing point will arise for the employee will be when they eventually sell the shares. From a CGT discount perspective, the CGT discount, as people may know, when you hold a CGT asset for at least 12 months, when you eventually sell that asset, the capital gains tax is effectively halved when you own the asset for more than 12 months. So when dealing with options, the starting point for the 12 months can vary. So from a taxed upfront scheme, the 12 months starts from the date that the options are issued. Tax deferred scheme, it's from the taxing point. From the startup concessions, the 12-month clock starts ticking from when the options are issued. So just to reiterate some of the tax outcomes that will be associated with the startup concessions. So when options are issued, there's no tax. When options vest, there's no taxing point. When options are exercised and converted into shares, there's no taxing point. Again, it's only when those shares are eventually sold, that's when CGT will be calculated. And the CGT will be calculated based on the difference between the sale price and the exercise price. It's quite common when an ESOP is issued to an employee that an employee may leave the company before they're able to realize any value, or before an exit event, or before various milestones occur. Now, the outcomes for the employee at different points in time, these can be tailored and adjusted based on how the plan rules themselves are set up. But in my experience, these are the sort of the common outcomes that I see when these particular events happen. So if an employee receives options and leaves before any of their options are vested, most commonly I see that those options lapse and are cancelled, and that's the end of the story for that particular employee. If options are vested but not exercised, often a few things could happen in this scenario. The employer may give notice to the employee that within 30 days or 60 days they need to exercise their options, or they are or they lapse, or alternatively the employee may buy back the options at the market value at that particular point in time. There's a few different scenarios that can be worked through where that happens. If the options have been exercised and converted into shares and then the employee leaves, so as I mentioned earlier, generally when the employee becomes a shareholder, they're party to the shareholders agreement. Most likely the rules around whether they get to keep their shares are governed by that particular document. So that may be similar where if they receive their shares via an employee share scheme, they're directed to sell the shares, or they're allowed to keep it, and because they've hit their KPIs, they've hit their milestones, and the vesting conditions have been satisfied, so they're entitled to keep the value that they've unlocked. Again, these are the common examples of what I see in these scenarios. It can all be tailored within the plan rules as needed. So just to touch back on the capital gains tax that we mentioned before. So the capital gains tax is paid on the difference between the exercise price and the eventual sale price of the share. And the 50% discount will apply so long as the shares are sold more than 12 months after the date the options are issued. So that's the background on the sort of the tax outcomes of the schemes. But it's important to note that not every company or every employee participant will be eligible to receive those tax concessions. So going through from a company condition or company criteria perspective, what boxes does the company need to tick to be able to set up a plan like this? So firstly, aggregated turnover of the company needs to be less than $50 million. Now, aggregated turnover means the turnover of the company plus the turnover of certain related companies like subsidiaries, or if there's a significant shareholder that owns more than a particular threshold of shares, we aggregate all those turnovers to determine whether we reach that particular threshold. Another important criteria is that the company, as well as any subsidiaries of the company, need to be incorporated for less than 10 years. The company cannot be listed on a stock exchange, either here in Australia or overseas. The employing company needs to be an Australian resident. Now, you can have a situation whereby a foreign company sets up a subsidiary here in Australia, and that the foreign company and all of its other subsidiaries satisfy the other criteria. We can set it up such that an employee of an Australian company owned by a foreign company can issue shares in that foreign company and still receive these tax concessions, as that is possible. And finally, the exercise price of the option must be at least the value of the underlying share at the time the option is granted. So if the value of the company or if the value of a share in a company is $1 per share at the date that the option is granted, we need to set the exercise price to at least be $1. Now, obviously, from the date the option is granted to the date that it's exercised or sold, presumably the value of the company is going to increase. That increase in value has no impact on this criteria. It's the testing point from a valuation perspective is the date that the option is granted. There are some employee criteria that need to be met. Or the participant needs to be employed by the company at the time they acquire the options. Now, by employed, if the legislation gives a reasonably broad definition of that. It states that the participant needs to be in an employment-like relationship. So that can include your traditional employees under an employment contract. It can include directors who aren't necessarily covered by an employment contract, but they are paid directors' fees because of their services on the board. And it can also extend to contractors in certain circumstances. So there's a broad range of people that can get eligibility for this. It just needs to be allowed within the plan rules for a director to participate or a contractor to participate in the plan. The resulting share must be an ordinary share as opposed to a preference share. So the ATO is, again, given a reasonably broad definition of what constitutes an ordinary share. They've basically said it's any share that's not a preference share. So that may mean that the employees participating might get a certain class of share that might have slightly different rights attached to it compared to the general shares that are on issue in the company. But just so long as they're not a preference share, which basically gives that shareholder certain preferences in a liquidation event, for example, so long as they don't constitute a preference share, then they're an ordinary share under this definition. So then those participants can get these concessions. The ESOP needs to satisfy an integrity rule designed to prevent contrived schemes. By that I mean that the purpose for setting up the scheme really needs to be commercially driven. It can't just be a purely tax-driven scheme to get particular manufactured outcomes that don't have a commercial basis. An important one here to understand is that there's a minimum holding period of 3 years relating to any options issued under startup concessions. So by that I mean, if the option is issued today, they vest and exercise in 12 months' time and convert to shares, the employee cannot sell that share until the 3rd year anniversary from when the option was issued. Now, that restriction will extend into a listed environment. So if the company lists subsequently, they're still restricted from disposing those shares until that 3rd year anniversary. The only exception to that rule is where 100% of the shares in the company are disposed of in a takeover event. At that point in time, the commissioner will allow us to accelerate that minimum holding period so that the employee participant can realise the upside in that scenario. And finally, the employee participant on a fully diluted basis cannot own more than 10% of the company, which basically means that founders and other significant shareholders cannot participate. Okay, so once we've satisfied, or once we've gone through the criteria on how to become eligible, I'll just run briefly through how we go about setting up an employee share scheme or an ESOP. Okay, so all these phases that you see here and all these items, INCOP can assist with. Sometimes we can do the end-to-end. Other times we work in conjunction with a client's lawyers who are setting up a lot of the paperwork side of things, and then the tax aspect is where INCOP can assist. So generally the 2 phases, the first phase really is, I guess, the tax sign-off phase, where INCOP can be engaged to review all those criteria that I went through on the previous slides, work with the company and their lawyers in some circumstances to help structure the plan to tick the boxes so that we can get tax eligibility. And normally we'll draft a memorandum, provide some written advice to basically have there as proof that we satisfy the criteria. The next phase, or the next step in that phase 1, will be to perform the accountant's valuation. As mentioned previously, the valuation is important because it's needed to determine what the minimum exercise price is. So we must at least meet that minimum exercise price to be eligible for the startup concessions, and INCOP can assist with that particular process. The second phase is the documentation side of things. Now, often in the way that our engagements run here, Incorp can provide these documentations, or alternatively, the company's lawyers can draft up these documents. We can do either way. So the ESS master plan is effectively a document that outlines how the plan is run, the rights and responsibilities of the employees, the rights and responsibilities of the board of directors in managing the plan. It guides what happens when an employee leaves, for example, or what happens when the company is sold. It's basically the master rules that sort of try to address all the different scenarios that could possibly happen. Employee offer letters are issued to each participating employee. And those offer letters will include a lot of the details specific to the employee. So it would detail things like the number of options that they're going to receive, the exercise price attached to those options, the vesting conditions, and those are the primary ones that will be disclosed. Now, each offer letter need not be the same for each participating employee. Some employees, for example, the vesting conditions might be based on a time-based vesting. Another employee might be based on a company milestone vesting condition. The number of options obviously will be different, but each of them would be consistent in at least meeting the minimum exercise price. So I mentioned a few times that the exercise price needs to be determined, and that's based on the valuation of the company. Now, specific to startup concessions, the ATO have released a safe harbor valuation, which is designed to be, I guess, administratively simpler compared to doing a formal, full-fledged valuation of a company. Now, they say they say safe harbor, which basically means if you adhere to the specific rules within for the safe harbor valuation, the ATO won't challenge the result that you get. Okay. The main difference or the main benefit of this safe harbor valuation is that it's based on the net tangible assets of a company. So it would exclude certain things like goodwill and the value of any off-balance sheet IP or other intangible assets that might be relevant to a particular business. And so that's useful and administratively simpler because valuing an intangible asset like IP can be difficult and also expensive. So I've got an example on the screen here as to what the valuation might look like. So you'll see the consolidated column where I've got the full balance sheet, which includes some intangible assets like legal costs, which we've capitalized, and also includes some goodwill on the balance sheet. So for the purpose of the tax of the valuation that we'll be doing, you would exclude those two intangible assets, which gives you obviously a different net asset result. So that in this example, the net tangible asset result is 632. We've got 100,000 shares on issue. And so that means that the value per share for this particular company will be $6.32. Now, if that company went to market and tried to raise capital or sold to an acquirer, the value of that goodwill would need to be considered, and it may be more or less than that $250 that's on my balance sheet. So I don't need to worry about what that value might be. So it's a pretty simplistic, it's a more straightforward valuation than the alternative. So if I've got a value of $6.32, that's now what my minimum exercise price needs to be. Just to make sure I've adjusted for any rounding errors or anything like that, I might make that $6.33 just to make sure that that minimum's met. Now, often for my clients, if you're a startup client, you might be operating at a loss, for example, where you might be pre-revenue and you're looking to do this, and 100% of your costs have gone into either a capitalized product development asset or expensed on the P&L. And those clients might have a net tangible asset value that's negative. Okay. In those scenarios, we would set the exercise price to be 1 cent for those particular participants. Even though, again, if that startup company were to raise capital, they would raise money at a value significantly more than 1 cent per share. But again, so long as we've adhered to the rules of this safe harbor valuation method, we can use that lower valuation, which is obviously more attractive from an employee perspective because it's less money for them to exercise, so it increases their potential upside. Okay, so that covers most of the content I wanted to go through. I think I've leave some time for people to post some questions if they thought of everything. I've got a few questions have been posted, so while everyone else thinks of them, I'll go through these ones. So the first question would be, how often do you have to do the valuation? Which is a good question. Obviously, the valuation can be time-consuming and come at cost every time that we need to do the valuation. So in theory, we'll do the valuation every time the options are granted. So if we're issuing options every month, for example, you'll probably take a pragmatic view and say, so long as the company's circumstances haven't changed materially, we could accept one every quarter. In practice, I find that clients tend to issue options one-off when they set up the plan, and then probably they would issue options on an annual basis is what tends to happen, in which case you would do the valuation once a year in those scenarios. Another one was, how often should a company review or adjust its ESOP plan? It's a good question. Generally, so long as we're still eligible for startup concessions, I wouldn't necessarily amend the plan rules. The main reason or the main driver that I find to edit the plan rules would be when we're no longer eligible for startup or we go into a listed environment. Because remember, the startup concessions require that 3-year restriction on disposal. Now that restriction is specific for startup concessions, and if we're not eligible for startup concessions, we might as well have a set of plan rules that don't have that restriction. It's too restrictive and it's not necessary. So once we cease eligibility for startup concessions, I'll tend to recommend a new set of plan rules be adopted. Now, again, the criteria is assessed at the date that the options are granted. So just because I issue options now under startup concessions, next year I'm no longer eligible for startup concessions, it doesn't impact any options previously issued under the plan. It will just be for the options going forward. Another one, to clarify, if a company had prior year losses on their returns, will that help reduce their net tangible asset valuation? Not directly. I mean, obviously, if it doesn't impact it over and above what I see on the balance sheet. So losses in general would be reflected as a debit just to put some accounting stuff out there. It'll be reflected as a deficit in net assets, and so that will, just by nature of the fact that the losses are recorded through your financial statements, that will reduce my net tangible assets as a result. So it's basically limited to what I see on the balance sheet. I don't do any further adjustments based on what the tax return says. No. Okay. I'll just give it a moment for any other questions to pop through. Okay. I think that I don't think I'm going to get any other questions, so I'm happy to leave it there, folks. Now, my contact details should have been in the registration information. So if you did have any questions or you wanted to organise a complimentary call to explore these concepts to see if it's applicable or appropriate for your business, I'm happy to do that. So please reach out to myself, or if you're an existing client of Incorp, whether your account manager is, they can put you in contact with myself, and I'm happy to have those initial conversations with you. Okay. So thank you all for attending. Have a good day.